The past few days have felt like a pressure cooker moment for the global market, because once again, China tariff threats burst back into the headlines, and instantly, everything shifted. Stocks jumped, then dipped, then froze in place. Supply chain dashboards started flashing like warning indicators. Analysts fired off late-night reports before sunrise, and investors, especially retail investors, were left asking the same thing. Is this the start of something big, or just another temporary shockwave? Because whenever tariff talk heats up, prices don't wait for confirmation. Manufacturers begin recalculating costs, international orders slow down, tech companies stiffen up, and the market moves before anyone has time to process it. But here's the twist most people completely overlook. In moments like this, informed investors aren't panicking, they're preparing. Because tariff waves don't just bring volatility. They open up entry zones, rotation patterns, and short-term opportunities that many investors miss while they're busy worrying. In today's video, we're going to break down what just happened, why the market reacted the way it did, and how you, as an everyday investor, can navigate these tariff tremors with clarity, confidence, and strategy. Take a breath, because the real picture is bigger and way more revealing than the headlines made it look. When tariff headlines exploded this week, most people only saw the surface story. China tariffs might return. But underneath that headline, something much deeper was unfolding. And it took Wall Street by surprise. Because the moment tariff discussions enter the room, the market doesn't wait for official action. It reacts to expectation. And that's exactly what we witnessed. Within hours, shipping indexes crept upward. Raw material suppliers froze new deals, and tech exporters quickly started adjusting their cost projections. Even major retailers, the ones heavily dependent on imported inventory, quietly shifted their short-term buying plans. And here's what most retail investors miss. Tariff threats behave like shockwaves. They hit sectors tied to China's manufacturing muscle first: electronics, appliances, auto parts. Then the ripple spreads into logistics, retail, and even consumer sentiment. But the real spark wasn't just the word tariff, it was the speed. Analysts expected a slow, drawn-out negotiation cycle. Instead, the news hit like a flash strike, sudden, loud, and packed with uncertainty. And uncertainty is something the market prices in instantly. 3 signals showed up almost immediately. 1. Volatility jumped, not violently, but noticeably. A classic sign that big money is repositioning while retail traders are still processing the news. 2. Trade-sensitive sectors tightened. Not a crash, just controlled hesitation. A signal that institutional investors were tapping the brakes. 3. Safe positioning behavior kicked in. Small rotations toward defensive ETFs, increased attention on broad market funds, and a subtle shift from high-risk sectors into stability. And this is where the opportunity begins. Because when the market reacts emotionally before the facts arrive, tiny price distortions appear. And those distortions are where sharp investors find their advantage. When tariff fears break into the headlines, the impact doesn't begin on Wall Street. It begins deep inside the supply chain. Quiet, sudden, immediate. The first tremor hits the manufacturers, the backbone of the tech products we use every day. They don't panic. They prepare. Production timelines tighten, orders get spaced out, delivery windows shift. Small moves, but they signal a much larger change underway. Then the second wave hits import-dependent businesses, retailers, e-commerce brands, auto parts distributors, companies whose margins rely on steady, predictable shipping costs. The moment tariff chatter rises, they start asking, do we bring inventory early? Do we slow down ordering? Do we lock in pricing before it jumps? These adjustments never show up in breaking news headlines, but they absolutely shape how the market behaves. Because tariff threats don't just alter costs, they alter expectations. And the market reacts to expectations faster Then it reacts to any official decision. And right after the news broke, the shift was clear. Tech and semiconductor stocks hesitated, even if briefly. Logistics companies saw a quick bump in activity and attention. Retail projections nudged downward, just enough for analysts to track. This is the part most investors miss. The market responds to behavior, not just headlines. And when companies quietly start preparing, it means the next phase of movement is already forming. These early movements often create small price gaps, moments where emotional sellers step back and strategic investors quietly step in. So let's talk about you, the investor, and what this sudden tariff wave really means for your next steps. Not theory, not guesswork. Real moves you can make in the market we're in today. Because the moment these threats hit, the market shifted, fast. And to stay ahead, you have to shift with it. 1. Tighten your watch list immediately. Focus on the sectors reacting first. Tech, plus semiconductors. Retail, plus import-heavy brands. Logistics, plus shipping. If you see hesitation, softer momentum, sharper volume, small dips, that's your early signal. Not a signal to panic, a signal to prepare. 2. Shift a slice of your portfolio towards stability, not fear. You're not retreating from the market. You're giving yourself breathing room. That means adding moderate exposure to broad market ETFs, low volatility funds, steady dividend positions. This stabilizes your base so you're not forced into emotional selling when volatility jumps. This isn't hiding, it's balancing. 3. Use the dips, but only where the impact is real. This tariff shock created pockets of weakness, not across the whole market, but in specific areas. Chip stocks, retail-heavy companies, supply chain-dependent manufacturers. These aren't crashes, they're discount windows caused by uncertainty, not deterioration. This is where strategic investors quietly accumulate. 4. Track volume. Because it tells the truth faster than the headlines. Watch 4. Sudden institutional buying after a dip. Volume increasing in defensive ETFs. Specific tech stocks stabilizing even when the news sounds negative. Volume is your radar. Commentary is just noise. 5. Don't try to win the tariff story. Aim to survive the noise and capture the rebound. Tariff cycles follow a rhythm. Shock, adjustment, opportunity, stabilization. We're in the adjustment phase right now, and this is where the smartest positioning happens. You don't need to predict the final outcome. You just need to respond to the market that's right in front of you. That's how you stay ahead. That's how you grow, even when the world feels chaotic. At the end of the day, this entire China tariff flare-up isn't about predicting the next headline. It's about understanding the movement behind the market. The shock already hit. The sectors already reacted. And the investors who stay calm, steady, and analytical are the ones who will come out stronger on the other side. You don't need to panic. You don't need to guess. All you need is clarity, controlled positioning, and the discipline to move with strategy instead of emotion. Moments like this separate the people who freeze from the people who stay focused and win. And if you want more noise-free, investor-focused market breakdowns, tap subscribe, turn on notifications, and stay ready for the next move, the next opportunity, and the next reality behind the headlines.